Securities and Exchange Commission of Sri Lanka, SEC, Act No. 19 of 2021 and the provisions enabled thereto. The SEC is presently working with the Colombo Stock Exchange to introduce regulated short selling through a securities borrowing and lending mechanism on 6 November 2023. In August 2021, under the guidance of the SEC, a delivery versus payment settlement mechanism was successfully implemented at the CSE. As the next step, the wheels are already set in motion to implement a fully fledged central counterparty mechanism. Capital markets act as powerful engines that contribute towards the growth of an economy. And the enhanced liquidity attributed to the introduction of regulated short selling through securities borrowing and lending would aid in developing the local capital market and the economy at large. When an individual sells a stock without owning the share, it is called short selling. It is the sale of a security borrowed by the seller. The sale comes with a promise to buy back the shares later. An individual short selling a stock has to mandatorily provide the shares at the time of settlement. Securities borrowing and lending is a mechanism where an investor can lend securities to an identified borrower for a predetermined period at an agreed-upon fee. Key benefits of SBL and RSS transactions. 1. SBL improves liquidity and creates efficiency in the market. 2. Reduces volatility in the market. 3. Increases market participation. 4. Enables the introduction of regulated short selling in the CSE. 5. Facilitates efficient price discovery. 6. Facilitate better risk management. The proposed framework includes safeguards such as identifying eligible securities for SBL and short selling, eligible participants, uptick rule, maximum quantity of an issued security that can be borrowed under SBL, default handling mechanism, and other features such as the process for handling corporate actions. Before making short selling, should be fulfilled 2 criteria. 1. The short seller should have borrowed the shares through an SBL transaction prior to the short sale. 2. The short seller is required to carry out an SBL transaction, and the shares borrowed through such SBL transaction should be credited to the borrower's CDS account by end of day. If the required shares are not credited to the short seller's CDS account via an SBL transaction by T of the short sale as aforesaid, the short sell carried out by the seller would not be in conformity with the applicable rules, and the seller shall be required to purchase the number of shares subject to the short sell from the buy-in board by T+1. An uptick rule will be applicable for short selling. Number 1. If the price of a share declines by 10% from the previous closing price, the system will validate the short sale orders submitted subsequent to the price depreciation based on an uptick rule. Number 2. Under the uptick rule, a short sell order must be at least 1 tick size above the last traded price of the share. If the price of the security declines by 20%, regulated short selling will not be permitted until price appreciates back to the permitted level. Short selling is carried out with the belief that the price of a security will decline, which enables it to be bought in the future at a lower price to earn a profit. This strategy pays off only if the price of the security drops from the date of sale to the date of repayment. Now, we turn into Asian market Indian context. The short selling strategy was banned in the first decade of the 21st century in the South Asian nations. In India, it was banned by the Securities and Exchange Board of India in March 2001. The reason behind the ban was the crash in the stock market due to the allegations on the then president of the Bombay Stock Exchange. There were allegations that he used confidential information from the surveillance department of the exchange to make personal gains and contribute to the volatility in the market. The Securities and Exchange Board of India banned short selling in Indian markets in March 2020 as a measure to curb the spread of COVID-19. The ban was implemented due to the market volatility caused by the pandemic and the subsequent economic slowdown, which led to a sharp decline in stock prices. The ban was intended to stabilize the markets and protect investors from further financial losses. Today, South Korea will prohibit stock short selling until June 2024 to allow regulators to actively improve rules and systems. The Financial Supervisory Service in October said it would likely fine 2 Hong Kong-based investment banks it determined had engaged in naked short selling transactions worth 40 billion won and 16 billion won respectively.